Hey everyone! Something happened in silver that I don't want you to brush off as just another overnight move. As of early this morning in New York time, silver is sitting around $80.58. And in the last 24 hours, it's up about 3.7%. That's not a casual drift, that's a statement. Because when silver moves like this, it's not usually polite. It's usually violent. It's usually fast. And it usually catches people leaning the wrong way. And here's the part that should make you pay attention. Gold is up too, but not like silver. Gold is around $5,005 an ounce, up less than 1% over that same window. So we've got silver sprinting, gold jogging, and if you've been tracking these markets long enough, you know that spread, the moment silver starts outrunning gold, can be a signal that something is shifting underneath the surface. Not guaranteed, not a crystal ball, but a signal. If you own any silver at all, even a small position, a 3.7% move isn't abstract. If you're holding, say, 1,000 ounces, maybe across coins, bars, or an ETF, that's roughly a move of about $3,000 in one day. That's the kind of swing that changes behavior. It changes headlines. It changes margin calls. It changes sentiment. But here's what mainstream commentary tends to miss in moments like this. The move itself is rarely the whole story. This goes deeper than what you're seeing on the surface. Let me show you the three things happening right now that make this specific silver move feel different than normal volatility, and why the next few sessions could decide whether this becomes a new floor or a trapdoor. First, the market is reacting to a world where central banks are still acting like they don't trust the system. You don't have to guess about that. China's central bank has been adding gold again, continuing a buying streak that's now well over a year long. And I want you to think about what that actually means in plain English. A central bank doesn't buy gold because they're feeling trendy. They buy gold because gold is outside the political system. It's outside the credit system. It doesn't require someone else's promise to pay. So even when gold isn't exploding in a single day, that steady official demand can create a psychological backstop for the entire precious metals complex, especially when investors already feel like the macro environment is unstable. And when gold has a bid underneath it, when it feels supported, silver tends to become the higher octane version of the same trade. Second, the Fed situation is not resolved, even if the last decision was a hold. The Federal Reserve kept rates where they are, but the part that matters is this. There were dissenters who prefer to cut. That tells you something important. It tells you the debate inside the Fed isn't simply higher for longer forever. There's pressure, there's concern, there's disagreement, and markets don't wait for the press conference to be over to price that in. They start gaming out the next step. Because if the Fed is closer to easing than the headlines suggest, even if it's not immediate, then real yields can soften, the dollar can wobble, and precious metals can catch a tailwind. And again, silver tends to react in a more exaggerated way than gold. Third, silver is a market where positioning matters more than people admit. Silver isn't just a store of value metal, it's also an industrial metal. It's also a paper leverage market. And it's also a market where momentum traders love to pile in once a move starts. That combination is why you can get these snap moves that feel almost disconnected from the calm, rational story people want to tell. A lot of silver trading is not about someone lovingly buying a coin and putting it in a safe. It's about futures positions, options exposure, and funds that need to adjust risk fast when volatility kicks up. So when silver starts ripping upward, 3.7% in a day, what you're often seeing is not just demand. You're seeing demand plus reflexive buying, shorts covering, traders chasing, algorithms reacting, risk managers forcing changes, and that's exactly why this could be the start of something bigger, or it could be the kind of spike that fades if it can't hold key levels. Now let's stack the evidence in a way that actually helps you make sense of what's happening, without charts, without hype, and without pretending anyone has certainty. Smart money moved before the crowd noticed. And I'm going to break this down in three layers: institutional behavior, technical structure, and fundamentals. Let's start with the institutional layer, because that's the slow-moving force that creates the backdrop. When a major central bank keeps adding gold month after month, it changes the psychology of the gold market. It reinforces the idea that gold is not a barbarous relic. It's a strategic reserve asset, and that matters for you even if you never buy a single ounce of gold, because gold is the anchor of the entire precious metals narrative. When gold has credibility, silver becomes the expression trade. It becomes what people reach for when they want upside torque. So even though today's move is silver-led, you have to see the environment, official sector accumulation, growing distrust in fiat stability, and an investor base that's constantly scanning for the next wave. The other institutional piece is the Fed path. When the Fed holds rates but shows internal pressure toward cutting, that's gasoline for metals. Not instantly every time, but structurally. Because metals don't need rates to be low. Metals need confidence in the currency and confidence in the real return on cash to be stable. The moment that confidence cracks, when people start thinking, wait, the Fed might be forced to ease into weakness, that's when gold benefits first. And when gold benefits, silver often overreacts. Now let's talk about the technical layer in normal human language. I analyze the price action, and what jumps out is not just that silver is up, it's how fast it's up relative to gold. A 3.7% move in a day tells you silver is in a higher volatility regime right now. That's the kind of regime where key levels matter because markets get emotional around round numbers. $80 is a headline number. It's a psychological number. And when silver pushes and holds above a psychological level, it tends to do one of two things. Either it consolidates, meaning it cools off but stays elevated, then makes another push, or it rejects, meaning it spikes above the level, fails to hold it, and then you get a sharp pullback that punishes the late buyers. This is why the new floor question is real. Not because I'm trying to be dramatic, but because markets are basically giant voting machines for price levels. If silver can stay in this zone, around 80 and above, without immediately giving it back, that tells you demand is absorbing supply. But if silver can't stay there, then this becomes a story about volatility and positioning, rather than a structural shift. Now the fundamentals. People love to argue about silver fundamentals in extremes. One side says, silver is money, it's going to the moon. The other side says, silver is just another commodity. The reality is, silver is both. Silver is an industrial input and a monetary metal, and that creates a unique pressure cooker dynamic. When industrial demand is strong or expected to be strong, silver gets a baseline bid. When monetary fear rises, currency fear, debt fear, geopolitical fear, silver gets speculative demand on top of that. So silver can go from slow and boring to violent and fast in a way that most markets can't. And the move you're seeing now, up 3.7% in a day, looks like that second component waking up. It looks like the monetary speculative component turning on. Now I want to ground this in a historical parallel, because history doesn't repeat perfectly, but market psychology rhymes. We've seen this exact pattern before. Back in the 2020 cycle, precious metals didn't move smoothly. They lurched. Gold moved first as fear spiked, silver lagged, and then silver exploded. And the important part wasn't just the rally, it was the whiplash. There were sessions where silver would surge, then rip lower, then surge again. Not because the world's silver mines changed overnight, but because positioning changed overnight, because leverage was involved, because traders were crowded, because headlines hit and algorithms responded faster than humans could. And if you lived through that, you remember what it felt like. Every day you woke up, the price was somewhere else. The lesson from that period isn't silver always goes up. The lesson is that when silver enters a volatility window, the range expands. Your normal expectations stop working. A 1% day becomes a small day. A 3 to 4% day becomes normal. And that's where people get hurt, because they size positions as if the world is calm, and then the market reminds them it isn't. Now let's make this personal, because none of this matters if it doesn't connect to your money. Let me show you what this actually means in real dollars. If you're holding physical silver, you might feel great today, and you might. A 3.7% move is a win. But here's the real question. Can you stomach the other side of that move if it snaps back? Because in silver, what you gain quickly, you can also give back quickly. If silver is around $80.58 right now, and we get a normal volatility snapback of, say, 5%, that would take you down to around 76.5. On 1,000 ounces, that's roughly $4,000 down in a hurry. And for a lot of people, that's not just a number. That's a car repair. That's a month of groceries. That's a mortgage payment. That's a tuition bill. So the real risk in silver isn't just up or down. It's whether your position size matches the volatility of the asset. Now, if you're more of a portfolio investor, maybe you've got a traditional stock and bond setup, and you added a small metal slice as a hedge, the question is different. The question becomes, is this metals move signaling a shift in the macro environment that could show up elsewhere? Because when metals start moving, it can be the smoke before the fire. Not always, but often enough that it's worth watching. If the market is starting to believe that central banks will keep accumulating hard assets, and that the Fed path is not as stable as people want to believe, then that's not just a silver story. That's a currency confidence story. That's a policy story. That's a purchasing power story. And the reason I'm emphasizing that is because it helps you avoid the trap of watching price like it's a casino scoreboard. Instead, you start asking the right question. What environment would justify silver holding an $80 handle as a new normal? Because if silver holds, it implies ongoing monetary demand, plus ongoing industrial demand, plus the return of speculative participation. If silver fails, it implies the move was mostly positioning and momentum. Either way, the next few sessions matter more than the headline today. Look, the question isn't whether we see more volatility. The math is clear. Silver just printed a move that tells you volatility is back at the center of the story. The real question is, are you positioned for what comes next? In every previous cycle where confidence in paper assets got shaken, hard assets preserved purchasing power better than most people expected, while paper promises got repriced brutally. Right now, silver sits around $80.58. Gold is around $5,005. The next week, especially as U.S. trading gets fully underway, will determine whether this was the beginning of a new floor or the kind of spike that sets up a shakeout. I share real-time updates and deeper analysis on social media. For those wanting exclusive research, members-only analysis, or early warnings, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations, but the fundamentals tell the story. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think silver is headed by the end of this week? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype, so the algorithm knows you're here for the original. 3. Next video drops tomorrow. I'm covering the one data point that could decide whether this move becomes a true new floor or whether the market is setting a trap right here at 80. You won't want to miss it. See you there.